Welcome to Thoughts on the Market. I am Vishy Tirupattur, Morgan Stanley's Chief Fixed Income Strategist.
And I'm Martin Tobias from the U.S. Interest Rate Strategy team.
Yesterday, the U.S. stock market shot up quite dramatically after President Trump paused most tariffs for 90 days. But before that, there were some stresses in the funding markets. So today, we will dig into what those stresses were and what transpired and what investors can expect going forward. It's Thursday, April 10th at 11:30 a.m. in New York. President Trump's Liberation Day tariff announcements led to a steep sell-off in the global stock markets. Marty, before we dig into that, can you give us some funding markets 101? We hear a lot about terms like SOFR, effective Fed funds rate, the spread between the two. What are these things, and why should we care about this?
For starters, SOFR is the secured overnight financing rate, and the effective Fed funds rate, EFR, are both at the heart of funding markets. Let's start with what our listeners are most likely familiar with, the effective Fed funds rate. It's the main policy rate of the Federal Reserve. It's calculated as a volume-weighted median of overnight unsecured loans in the Fed funds market. But volume in the Fed funds market has only averaged $95 billion per day over the past year. SOFR is the most important reference rate for market participants. It's a broad measure of the cost to borrow cash overnight collateralized by Treasury securities. It's calculated as a volume-weighted median that covers three segments of the repo market. Now, SOFR volumes have averaged $2.2 trillion per day over the past year.
So what you're telling me, Marty, is that the difference between these two rates really reflects how much liquidity stress is there, or the expectations of the uncertainty of funding uncertainty that exists in the market. Is that fair?
That's correct. And to do this, investors look at futures contracts on Fed funds and SOFR. Now, Fed funds futures reflect market expectations for the Fed's policy rate. SOFR futures reflect market expectations for the Fed policy rate and market expectations for funding conditions. So the difference or basis between the two contracts isolates market expectations for funding conditions.
So this basis that you just described, what is the normal sense of this? How many basis points is the typical basis? Is it positive? Is it negative?
In a normal environment, over the past 3 years when reserves were in abundancy, the 3-month SOFR Fed funds futures basis was positive 2 basis points. This reflected SOFR to set 2 basis points below Fed funds on average over the next 3 months.
So what happened earlier this week is SOFR was setting above the effective Fed funds rate, implying
tighter funding conditions.
So Marty, what actually changed yesterday? How bad did it get, and why did it get so bad?
So 3-month SOFR Fed funds tightened all the way to negative 4 basis points. And we think this was a reflection of investors' increased demand for cash. Whether it was lending more securities outright in repo to raise cash, or selling securities outright, or even not lending excess cash in repo. This caused dealer balance sheets to become more congested and contributed to higher SOFR rates.
So let's give some context to our listeners. This is clearly not the first time we've experienced stress in the funding markets. In previous episodes, how far did it get? And give me some context.
Funding conditions did indeed tighten this week, but the environment was far from true funding stress like in 2019 and certain periods in 2020. Now, in 2019, when funding markets seized and the Fed had to intervene and inject liquidity, 3-month SOFR Fed funds basis averaged negative 9 basis points. And that compares to negative 4 basis points during the peak macro uncertainty this week.
So, Marty, what is your assessment of the state of the funding markets right now?
Right. Funding conditions have tightened, but I think the environment is far from true funding stress. Thus far, the repricing has occurred because of a higher floor for funding rates and not a scarcity of reserves in the banking system.
So to summarize, the funding stress has been quite a bit earlier this week. Not as bad as the worst conditions we saw, say, in 2019 or during the peak COVID periods in 2020, but still pretty bad. And relative to how bad it got, Today, we are slightly better than what we were 2 days ago. Is that a fair description?
Yes, that's good. Now, Vishy, what is your view on why the longer end of the bond market sold off?
Longer end bond markets, as you know, Marty, while safe from a credit risk perspective, do have interest rate sensitivity. So the longer the bonds, the greater the interest rate sensitivity. So in periods of uncertainty, such as the ones we are in now, investors prefer to be in ultra short-term funds or cash to minimize that interest rate sensitivity of their portfolios. So what we saw happening in some sense, we can call it dash for cash. I think we both agree that this demand for safety will persist, and we will continue to see inflows into money market funds, which you covered in your research. So your insights, Marty, will be very helpful to clients as we navigate these choppy waters going forward. Thanks for taking the time to talk to us.
Great speaking with you, Vishy.
And thanks for listening. If you enjoy Thoughts on the Market, please leave us a review wherever you get this podcast and share with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.
Yesterday, all my troubles were so far away. I believe in yesterday.